What if the investment that feels the most rational right now is the one carrying the most dangerous structural risk in the entire market? Not a speculative bet, not a meme stock, not a crypto token. The companies sitting at the top of every major index. The names your financial advisor calls blue chip and reliable. Michael Burry has been analyzing this question for years. He has published the data that supports a deeply uncomfortable answer. Almost nobody in mainstream finance wants to discuss what that data implies. Today, we examine Burry's complete framework for identifying overvalued markets, the specific signals he watches, and what history tells us happens when those signals are consistently ignored. By the end of this analysis, that question will not feel abstract. It will feel urgent. Michael Burry is not a product of Wall Street. He is a former medical doctor who built one of the most precise analytical track records in modern financial history by doing something almost nobody else was willing to do. He read the original documents, all of them. While analysts summarized earnings calls, Burry read the original filings. While institutions followed consensus models, Burry built independent frameworks from primary sources. In 2005, Burry identified a systemic flaw in the American mortgage market 3 full years before the collapse. He built a position against the entire system. His own investors tried to withdraw their capital. His prime broker froze his accounts. Wall Street dismissed his thesis as the work of a confused outsider with no institutional experience. In 2008, his fund returned 489% while the global financial system collapsed around it. The firms that had laughed the loudest either failed or required taxpayer rescue. This is the analyst whose framework on overvalued markets we are about to examine. To understand Burry's argument about overvaluation, we need to understand how asset prices are supposed to function in a healthy market. In a market operating with genuine price discovery, prices reflect the collective judgment of buyers and sellers who are each independently evaluating the underlying value of what they are trading. A company's stock is worth what its current earnings, its balance sheet, and its realistic future prospects justify. When a stock trades far above those fundamental values, it is overvalued. When an entire market trades far above those fundamental values across thousands of stocks simultaneously, the overvaluation becomes systemic rather than isolated. Burry argues that this is precisely the condition that defines the current environment. What makes his analysis particularly specific is his identification of the mechanisms responsible. The rise of passive index investing over the past 2 decades has redirected trillions of dollars away from active fundamental analysis and toward automatic price-indifferent buying. The period of near-zero interest rates maintained by the Federal Reserve from 2008 through 2022 artificially elevated the mathematical valuations assigned to equities across the board, and the prolonged bull market that resulted from those conditions progressively eliminated the institutional skepticism that once acted as a natural corrective force. Burry does not describe these as temporary inefficiencies that self-correct quietly. He describes them as structural distortions with a specific and violent resolution mechanism. Burry's central thesis on overvalued markets rests on 3 interconnected arguments. First, that passive capital flows have inflated equity prices mechanically, without reference to underlying value. Second, that the interest rate environment of the past decade compressed discount rates to levels that made almost any future earnings projection appear to justify almost any current price. Third, that the behavioral dynamics of a prolonged bull market have systematically eliminated the skepticism that normally acts as a corrective force. According to Burry's analysis, these 3 forces operated simultaneously and in the same direction for an extended period. What makes this configuration particularly dangerous is not any single element in isolation. It is the fact that all 3 reinforce each other. Cheap money funds, passive vehicles. Passive vehicles inflate prices. Rising prices suppress skepticism. And suppressed skepticism allows cheap money to continue funding passive vehicles in an accelerating loop. Burry calls this a self-reinforcing distortion. When it reverses all at once. The first pillar of Burry's overvaluation framework is mechanical price inflation through passive vehicles. When an index fund purchases shares of a company, it is not evaluating whether the current price reflects the company's actual worth. It is buying because the company is in the index and capital has flowed into the fund. As more capital flows into passive vehicles, more automatic buying pressure falls on the largest components of the index. In a capitalization-weighted index, the companies with the highest market capitalization receive the highest allocation of every new dollar invested. This creates a feedback loop. As prices rise for the largest companies, their weighting in the index increases, which means each new dollar flowing into the fund buys proportionally more of them, which pushes their prices higher still. Burry drew a direct parallel to the collateralized debt obligation market before 2008 in a public interview with Bloomberg in 2019. In that crisis, mortgage securities were pooled and sold without any analysis of the individual loans inside them. Capital flowed based on the structure of the vehicle, not the quality of the underlying assets. In passive investing, capital flows based on the composition of the index, not the fundamental value of the individual companies inside the fund. The analytical process that should connect price to value has been removed from the system. According to Burry, removing that process does not create efficiency. It creates fragility, because it removes the mechanism by which overvaluation is recognized and corrected before it reaches catastrophic levels. As Burry noted in that interview, the theater is only so large, but the exits are getting smaller every year, and most of the people inside have never seen the lights go out. The second pillar is what Burry has identified as the discount rate distortion. Every standard valuation model depends on discounting the present value of future earnings. The rate applied in that calculation reflects what an investor could earn in a risk-free alternative. When risk-free rates are near zero, the denominator in that calculation collapses. And when the denominator collapses, the present value of future earnings rises dramatically. A company projecting significant earnings growth 10 or 20 years from now appears dramatically more valuable at a 2% discount rate than it does at a 6% discount rate. The mathematical difference is not marginal. It is the difference between a reasonable valuation and an extraordinary one built on numbers that only exist in a specific policy environment. Burry has consistently argued that the valuations assigned to high-growth technology and innovation companies during the era of near-zero interest rates were not primarily a reflection of those companies' business quality. They were primarily a reflection of the discount rate artifact created by Federal Reserve policy. According to Burry's analysis, the Fed's interventions did not create real economic value. They created the numerical appearance of value by manipulating the rate used to translate future earnings into present prices. When rates normalize to levels consistent with historical inflation and economic growth, the valuations assigned during the zero-rate era do not hold. They revert. Not gradually, not partially, structurally, because the mathematical foundation on which they rested has been permanently altered. The third pillar is behavioral. Burry has studied extensively the psychology of extended bull markets and the progressive erosion of skepticism that accompanies prolonged asset price appreciation. According to his analysis, several behavioral dynamics emerge simultaneously as a bull market matures. Professional fund managers, who underperform the benchmark index, face compounding pressure from clients and institutional boards to match or exceed those benchmark returns by accepting more risk. Analysts who publish bearish research on widely held names find their work dismissed, their access to management restricted, and their career trajectories penalized. Financial media develops an institutional bias toward optimistic coverage because optimism generates engagement and advertising revenue. and retail investors who have experienced only rising markets come to interpret any volatility as a buying opportunity rather than as a structural signal of underlying stress. Burry has described this collective dynamic as a narrative prison. Once the consensus locks firmly onto a directional view, the social, professional, and financial cost of dissenting becomes high enough that most participants stop dissenting even when the underlying data supports a different conclusion. The warning voices do not disappear because the data changes. They disappear because speaking becomes too costly. By the time overvaluation reaches its most extreme levels, the corrective mechanism has been largely silenced from within the system. Burry's framework also identifies specific quantitative metrics for assessing systemic overvaluation. He has referenced the cyclically adjusted price-to-earnings ratio, which normalizes earnings across a 10-year cycle to remove the distortions introduced by single exceptional years. He has referenced the ratio of total market capitalization to gross domestic product, which compares the aggregate paper value of all public companies to the actual size of the underlying economy that supports them. He has referenced margin debt levels, which measure the total amount of borrowed capital being deployed to purchase equities. And he has highlighted the concentration of market capitalization in the 5 to 10 largest companies within major indices as a structural signal of systemic fragility. According to Burry's analysis, when these metrics simultaneously reach levels that have historically preceded major corrections, the case for caution is not driven by pessimism. It is driven by pattern recognition across multiple independent data series, pointing in the same direction at the same time. Burry is explicit that no single metric determines the timing of a correction. Markets can remain overvalued far longer than any rational framework suggests possible. But when multiple indicators simultaneously reach historical extremes, the question shifts from whether a structural correction is coming to when it will arrive and how severe it will be. Historical analysis is central to Burry's methodology. He has pointed explicitly to the 1999 technology bubble, the 2007 credit bubble, and the conditions preceding the 1929 collapse as templates for understanding how systemic overvaluation ultimately resolves. In each instance, prices rose beyond any sustainable fundamental justification during a period of excess liquidity, structural leverage, and behavioral euphoria. The analysts raising concerns were marginalized as the bubble inflated. The corrective mechanism reasserted itself with speed and severity that the consensus had not modeled. Burry's argument is not that history repeats precisely. The instruments change, the participants change, the specific narratives that justify the valuations change. What does not change is the underlying dynamic. Cheap money enables excess. Excess enables euphoria. Euphoria silences skepticism, and silenced skepticism allows structural imbalances to build until the weight of them can no longer be supported by economic reality. Burry has argued in public communications that the specific cause of the next correction is less important to identify than the structural conditions that make correction inevitable. When price and value are decoupled at scale, the reconnection is not optional. The only variable is time. Burry rarely provides direct investment advice to general audiences, but his methodology offers a clear framework that any investor can apply to their own approach. The first principle is to evaluate assets on fundamentals rather than narratives. Before accepting the consensus view on any investment, Burry demands answers to specific questions. What are the actual current earnings? What does the balance sheet show about debt, assets, and cash generation? What is the realistic growth rate given competitive pressures? And does the current price reflect demonstrated fundamentals or a story about what the company could become under optimistic assumptions? If the answer points primarily to narrative, Burry's framework demands skepticism. The second principle is to understand the actual composition of what you hold. Most investors in index funds know the fund name but have never examined the concentration of capital in the largest holdings, the current valuation multiples of those companies, or the conditions under which those multiples were assigned. Burry would insist on knowing exactly what you own, not just the label attached to it. The third principle is to model the exit before entering the position. Burry consistently evaluates not the optimistic outcome of any investment, but the worst-case exit scenario, specifically the scenario in which sentiment reverses simultaneously and liquidity contracts. If that exit is structurally manageable, the position can be held with rational confidence. If the exit depends on conditions that may not exist when everyone wants to leave at once, the risk has not been priced into the current entry. Today, we examined Michael Burry's complete framework for identifying systemic overvaluation in markets. We traced his three-pillar analysis from the mechanical inflation of passive capital flows to the discount rate distortions introduced by monetary policy to the behavioral silencing of corrective voices. We reviewed the quantitative signals Burry uses to assess when overvaluation has reached systemic proportions, and the historical patterns he argues follow predictably from those conditions. Burry's work does not require pessimism to understand. It requires the willingness to look at what the documents and the data actually say rather than what the consensus chooses to emphasize. The question his framework leaves each investor with is the one we opened with. Are you pricing the asset, or are you trusting the narrative? According to Burry's philosophy, when the structural correction arrives, that distinction will have mattered more than almost any other decision you made. Thank you for watching.